How do I calculate my capital gains when selling a property? Now, capital gain tax is the amount you pay on a profit you made from selling a property. Now, if I sell my property, how much tax will I have to pay? First things first, what exactly is your profit? Because tax is not calculated on your selling price, it is calculated on the profit you made. Your profit is simply your selling price minus your total cost. Now, your total cost can include the purchase price, which is the price you originally bought the property for. Another thing is cost of improvement, the money you spent on renovating, upgrading, or finishing the property. Another thing can be transaction costs, things like legal fees, agency fees, and documentation. So let's say, for example, you bought a property for 50 million. And over time, you have spent 5 million on renovation, you spent 2 million on legal fee and documentation. Your total is now 57 million, right? Now, if you sell your property for 100 million, your selling price is 100 million, total cost is 57 million. Your profit or capital gain is 43 million. Now, the 43 million is what will be considered taxable. Not the 100 million, which is the selling price, not the 50 million, which is the price you brought the property for. The tax is only on the profit, which is 43 million naira. Now, here is where it gets interesting under the new tax law system. This 43 million naira does not just sit on its own. It is added to the total income for the year. Then is now being taxed based on your income bracket. So let's say, apart from this sales of property, your normal income is 3 million naira a year. Now, your total income becomes 3 plus 43 million, which is 46 million. Now, you are no longer in the low tax bracket. You have moved to the higher bracket, which means a portion of your gain could be taxed at either 15, 18, 21%, or even as high as 25%, depending on where the 46 million naira mark is taxable. Now, one thing you must not ignore, if you have been following my series, you know I've been talking about proper documentation. I've been making serious emphasis on proper documentation. It is very important you have proper documentation that backs up your expenses, your cost price, and all of that. If you don't properly document your expenses, your renovation costs, your legal fees, your agency fees, you may not be able to properly present your case when it's time to pay your tax. And that means that your profit will look bigger than it actually is, which means higher tax. Higher profit is actually higher tax. So my final thought is, calculating capital gains is not just an accounting exercise, it's actually a strategic tool. You need to know how to calculate your capital gains, because once you understand your numbers, you can start asking better questions like, is this the right time to sell? Should I invest more into the property before selling? How do I reduce my taxable gain legally? Now, in my next video, we'll go deeper into how to legally reduce the tax you will pay when you sell your property. My name is Obi-Okuhon. Now, if you enjoyed watching this video, you should subscribe to my YouTube channel, like, comment, send this video to people who you know it will be beneficial to. Thank you, and see you in the next video.